There are moments in markets when something shifts quietly beneath the surface long before the headlines catch up. Today is Friday, 20th of February, and what I'm about to walk you through may represent one of those moments. Or it may turn out to be an elegant theory that simply arrived too early. I don't say that lightly. After reviewing the data, the technical structure, the historical precedents, and the supply realities, I find myself suspended between two possibilities. Either we are witnessing the early ignition of a structural repricing in silver that could unfold over years, or we are staring at an interpretation that will eventually be judged as overly ambitious. What I cannot dismiss, however, is the coherence of the thesis itself, because someone has put forward a $500 silver projection, and before instinct tells you to disregard that number as hyperbole, you need to understand what underpins it. This is not casual speculation. It is built on a 45-year technical formation, persistent structural supply deficits, and a gold-silver ratio so historically distorted that current pricing may reflect imbalance rather than equilibrium. So the real task here is not to react emotionally to the number, it is to examine the architecture behind it. What is happening in the silver market right now? Why does a 45-year chart pattern matter? What does the gold-silver ratio actually imply when viewed through geological and monetary history? And if we follow the logic step by step, does $500 become irrational, or does it simply become arithmetic? Let's begin with structure. According to the analysis I've been studying, the silver bull market is not nearing exhaustion, it has barely begun. What appears on the surface as strength is being described as the opening phase of a multi-decade repricing of what some analysts consider the most misaligned strategic asset in the global system. That is an extraordinary claim. It demands extraordinary scrutiny. The first element is technical, and it centers on a 45-year cup and handle formation visible on the long-term silver chart. For those unfamiliar with the pattern, a cup and handle forms when price creates a rounded base over time, followed by a smaller consolidation, and then breaks above long-standing resistance. In shorter time frames, this pattern can generate substantial moves. But when the structure forms across decades, it transforms from a trading setup into a generational signal. Silver's chart presents precisely that scenario. In 1980, during the Hunt brothers' attempt to corner the market, silver spiked toward $50. That event formed one rim of the cup. In 2011, during the post-financial crisis precious metal surge, silver once again approached the same $50 region. That created the opposite rim. Between those two peaks unfolded a prolonged, grinding correction. Silver fell into the teens, sentiment collapsed, and years of sideways rebuilding followed. That extended base carved out the body of the cup. Now consider what it means when price pushes through a resistance ceiling that has held for 45 years. This is not merely a breakout, it represents the absorption of decades of trapped supply. Every investor who bought near previous highs and waited years to exit at break-even has had the opportunity to sell. The overhead pressure dissipates. When that type of structural barrier is cleared, it signals the end of one pricing regime and the birth of another. The classical method for projecting targets from a cup and handle is straightforward. Measure the depth of the cup and add it to the breakout level. In silver's case, the base stretches from low single digits up toward the $50 cap. That measured move alone suggests a triple-digit silver price as an initial waypoint, not the final destination. A waypoint. The technical implication places the first major target well above $100 before any macro catalysts are even considered. Duration amplifies significance. The longer a pattern develops, the greater the potential energy embedded within it. A formation that has been building for 45 years does not typically resolve into a short-lived rally. If the structure is valid, we are likely in the early phase of a secular advance measured in years, potentially decades. Technical analysis alone is never sufficient. Patterns can fail. False breakouts occur. Charts provide frameworks, not guarantees. But when technical alignment intersects with fundamental imbalance, probability shifts, which brings us to supply. For multiple consecutive years, global silver production has failed to meet total demand. Mine output combined with recycling has not covered annual consumption. On its face, that should produce immediate and explosive price responses. Yet markets can sustain deficits for extended periods by drawing down accumulated inventories. Think of it as spending beyond income while slowly liquidating savings. The imbalance can persist as long as reserves remain. Historically, silver possessed a substantial above-ground cushion. Strategic stockpiles accumulated during the 20th century, remelted coinage, legacy government reserves, and industrial hoards provided a buffer that absorbed deficits without dramatic price consequences. According to the research supporting this thesis, that cushion has now largely dissipated. The deficits are no longer offset quietly by hidden inventories. They are eating into measurable, transparent stockpiles. Warehouse inventories that can be monitored are declining. Delivery pressures that once appeared theoretical are becoming visible in reported data. The long-discussed concept of physical tightness is shifting from narrative toward measurable trend. Complicating matters further is the structural nature of silver production. The majority of silver does not originate from primary silver mines. Instead, it is produced as a byproduct of mining other metals such as copper, lead, zinc, and gold. When copper miners expand operations due to favorable copper economics, silver output may increase regardless of silver's own price. Conversely, if copper production slows, silver supply may contract even if silver prices are rising sharply. This dynamic creates a disconnect between price and production response. Silver supply does not respond directly to silver's price incentives. Even when new primary silver deposits are identified, the timeline from discovery to commercial production frequently spans 15 to 30 years due to permitting, environmental reviews, financing complexities, and construction timelines. A structural deficit cannot be corrected quickly when the supply pipeline requires decades to activate. In the short and medium term, price becomes the only variable capable of restoring balance. And this is only the supply side of the equation. The transformation on the demand side may be even more consequential. Now shift your attention to demand, because this is where the narrative moves from imbalance to inevitability. Silver today is not the same asset it was 50 years ago. Historically, silver functioned primarily as money. It circulated in coins, backed currencies, and served as a store of value alongside gold. Industrial uses existed, but they were secondary. That relationship has reversed. Approximately 70% of annual silver demand now originates from industrial applications. Only around 30% is attributed to investment demand and jewelry combined. That reversal fundamentally changes how the market behaves. Silver is no longer primarily a speculative metal that rises only when investors feel fear. It is embedded in the architecture of modern technology. Silver is the most electrically conductive metal on Earth, not nearly the best, the best. When conductivity must be maximized in minimal space, silver becomes the preferred material. That is why it is used in photovoltaic solar panels, where conductivity directly affects efficiency. It is inside smartphones and computers, in the circuitry that enables processing and communication. It is present in electric vehicles, advanced medical equipment, 5G infrastructure, aerospace systems, and military hardware. The modern electrified world runs through silver. Not symbolically, physically. Electrical current flows across silver pathways in countless applications. And as global electrification accelerates, so does structural demand for the metal. Now here is where the situation becomes even more important. When silver is used in solar panels, solder, circuit boards, or microelectronics, it is typically dispersed in extremely small quantities across vast numbers of devices. Once integrated, much of that metal becomes economically impractical to recover. Recycling does occur, but only when recovery costs justify it. At current price levels, a large portion of industrial silver effectively disappears from the accessible supply chain once used. That means every year silver is consumed in ways that permanently remove it from above-ground inventories. It ends up distributed across rooftops, embedded in landfills, or locked inside electronic waste where extraction is uneconomical. Unlike gold, which is almost always stored and rarely destroyed, silver is actively used and dissipated. Layer that reality on top of chronic production deficits, and the structural picture becomes clearer. Demand is not only high, it is industrially non-discretionary. Solar installations, electric vehicle adoption, data center expansion, artificial intelligence infrastructure build-outs, and defense modernization programs all require silver. These are not trends likely to reverse abruptly. Even during economic slowdowns, long-term electrification initiatives continue. Now introduce the gold-silver ratio into the equation, because this is where the thesis transitions from structural stress to numerical projection. The gold-silver ratio measures how many ounces of silver are required to purchase 1 ounce of gold. For years, this ratio has fluctuated between roughly 60 to 1 and 80 to 1, occasionally spiking above 100 to 1 during periods of extreme financial stress. Yet geological production tells a different story. Current mining output produces approximately 9 ounces of silver for every 1 ounce of gold, 9 to 1. That is the natural extraction ratio. Historically, when both metals functioned as monetary anchors, the traded ratio commonly hovered between 10 to 1 and 17 to 1 for extended periods. In other words, both geology and monetary history suggest that the current paper ratio sits dramatically above long-term norms. The disparity is significant. If markets eventually reconnect with structural realities, the ratio must compress at some stage. It may not happen immediately. Divergences can persist longer than expected, but extreme conditions tend not to endure indefinitely. Now consider the math that generates the $500 projection. If gold were to trade at $5,000 per ounce, a level many analysts consider plausible in a world characterized by expanding sovereign debt, currency debasement pressures, and persistent central bank accumulation of bullion. And if the gold-silver ratio were to compress back to a conservative 10-to-1 relationship, then silver would mathematically price at $500 per ounce. 5,000 divided by 10 equals 500. That is the arithmetic. No exotic modeling, no speculative leverage assumptions, just ratio normalization combined with a higher gold baseline. Advocates of this framework emphasize that investors once viewed a move from $20 to $100 silver as aggressive. That was a five-fold increase. Yet mathematically, a move from $100 to $500 represents the same five-fold expansion. The difference lies in context. The second leg would unfold against tighter physical supply conditions, stronger industrial demand competition, and potentially elevated stress within global monetary systems. Now, we need to examine counterarguments seriously, because any thesis of this magnitude requires balance. First, mean reversion in the gold-silver ratio does not operate on a schedule. The ratio has remained elevated for extended periods before. It could remain elevated again. An anomaly does not guarantee imminent correction. Second, high prices influence demand behavior. If silver were to approach $200 or higher, manufacturers would intensify efforts to reduce silver usage in products. Substitution research would accelerate. Recycling would become economically attractive at scale. The demand composition at $500 silver would not mirror today's demand profile. Third, elevated prices incentivize exploration and supply development. Although bringing new primary silver mines into production can take decades, sustained high prices can justify previously uneconomic deposits. Recycling streams expand. Dormant inventories become attractive for liquidation. Fourth, technical formations can fail. A 45-year cup and handle is compelling, but markets are not obligated to respect patterns. False breakouts occur. Macro shocks intervene. Liquidity events distort structure. Fifth, silver operates within a heavily financialized futures market. Paper contracts can influence price discovery in ways that temporarily diverge from physical supply-demand realities. These distortions may not last forever, but they can last longer than anticipated. So where does that leave the thesis? It leaves it credible but not guaranteed. The logic holds internally. The structural deficits are real. The industrial transformation is measurable. The ratio divergence is observable. The math connecting these elements is straightforward. Yet uncertainty around timing, behavioral response, and macro shocks remains substantial. Perhaps the most important takeaway is not the specific number of $500, but the recognition that silver's structural positioning may be materially stronger than conventional pricing implies. It is both a monetary metal and a strategic industrial input. It faces supply constraints that cannot be resolved quickly. It exists within a global macro environment where debt burdens are historically elevated and monetary credibility is periodically questioned. As of Friday, 20th February, global fiscal deficits remain large. Interest obligations consume increasing shares of government budgets. Central banks have accumulated gold steadily for several years, signaling diversification behavior at institutional levels. Confidence in fiat systems has not collapsed, but precautionary positioning is visible. In such an environment, gold often advances first, reflecting monetary hedging demand. Silver, with its smaller market size and dual identity, has historically exhibited amplified moves once momentum takes hold. However, volatility must be expected. Silver is known for sharp corrections, even within bullish cycles. Being correct about direction does not eliminate interim drawdowns. Investors who underestimate volatility often exit prematurely. If someone finds this structural thesis persuasive, the implication is not reckless concentration, it is thoughtful allocation. Precious metals exposure should align with overall portfolio strategy, risk tolerance, and time horizon. Silver's potential upside must be balanced against uncertainty in timing and magnitude. For physical holders, the argument supports continued accumulation or retention if structural deficits persist. Physical metal eliminates counterparty exposure. For those considering mining equities, leverage to price movements exists, but operational and jurisdictional risks accompany it. The key question is not whether $500 occurs next quarter. It is whether the structural logic behind that projection is sufficiently sound to influence long-term positioning decisions. And that brings us to the final layer of this discussion. What observable developments would confirm or invalidate the thesis as markets evolve? That is where disciplined analysis replaces emotion and where conviction either strengthens or dissolves over time. If a thesis is going to prove itself over time, it does not do so through declarations. It does so through evidence. Markets communicate in structure, ratios, inventory flows, and capital allocation trends. So rather than obsessing over whether silver reaches $500, it is more productive to identify what developments would validate or contradict the path toward that outcome. Start with the technical structure. The breakout from the 45-year cup and handle must remain intact. A pattern of that magnitude cannot afford a decisive and sustained collapse back below the breakout region. If price were to fall meaningfully back into the prior multi-decade range and remain there, the structural interpretation would weaken substantially. But if silver continues to build higher highs and higher lows over time, consolidating constructively above the former ceiling, that behavior would reinforce the argument that a secular repricing phase is underway. Next, monitor the gold-silver ratio carefully. If the ratio begins compressing steadily, moving from the 60s into the 50s and then lower, that shift would signal relative strength in silver consistent with mean reversion dynamics. Compression does not need to occur violently. Even gradual contraction over several years would support the thesis. On the other hand, if the ratio expands again toward extreme historical levels without corresponding stress in physical supply, that would weaken the ratio-based projection. Industrial demand trends represent another confirmation layer. Solar capacity expansion, electric vehicle production growth, data center proliferation, artificial intelligence infrastructure investment, and defense modernization programs all contribute to silver consumption. If these sectors continue expanding structurally, the industrial demand case remains intact. A prolonged contraction across these sectors or a technological breakthrough that dramatically reduces silver intensity in critical applications would undermine the demand component of the thesis. Physical market signals also matter. Warehouse inventory levels, delivery premiums, lease rates, and episodes of backwardation in futures markets provide clues about tightness. Sustained drawdowns in deliverable inventories combined with persistent premiums would confirm that deficits are exerting pressure. Conversely, unexpected inventory surges or major undisclosed stockpile releases could shift supply dynamics. There are also clear invalidation scenarios. A decisive technical breakdown below long-term support would challenge the 45-year pattern interpretation. Major technological innovation that substitutes silver efficiently in solar cells or advanced electronics would alter demand projections. Significant new high-grade discoveries brought rapidly into production, while unlikely given regulatory timelines, could increase supply beyond expectations. Policy shifts that accelerate recycling efficiency on a large scale could also change the calculus. Beyond structural mechanics lies psychology. Extreme price targets provoke skepticism for good reason. Financial history is crowded with exaggerated forecasts that failed to materialize. The precious metal space has seen its share of overenthusiastic projections in prior cycles. Skepticism protects investors from impulsive decisions. But skepticism should not evolve into dismissal. Markets have repeatedly demonstrated that assets can reprice dramatically when structural forces converge. Oil in the 1970s, technology equities in the late 1990s, housing prior to 2008. In each case, participants initially debated whether moves were justified or excessive. The key difference lies in whether the underlying drivers are transient or structural. The appropriate way to handle a thesis like this is to separate components from conclusions. The technical structure can be verified independently. Production deficits are documented in industry reports. The industrial demand percentage is observable. The gold-silver ratio is measurable. Each element can be evaluated on its own merits. If those elements withstand scrutiny, then the arithmetic connecting them to higher prices becomes at least plausible. However, plausibility is not certainty. Timing remains uncertain. Even if the structural trajectory is upward, silver could experience prolonged consolidations. It could correct sharply during broader liquidity events. Being early often feels indistinguishable from being wrong. Investors must account for emotional endurance alongside analytical conviction. Consider the broader macro environment as of Friday, 20th of February. Global sovereign debt levels remain elevated. Fiscal deficits persist across major economies. Interest obligations consume growing portions of national budgets. Central banks have accumulated gold steadily for multiple consecutive years, signaling diversification behavior at the highest institutional levels. While fiat systems remain operational, precautionary positioning is visible. In such a backdrop, gold often responds first to monetary concerns. Silver, with its smaller market capitalization and dual industrial monetary character, historically exhibits amplified moves once momentum builds. If gold were to advance meaningfully under macro pressure and the gold-silver ratio began compressing simultaneously, silver's price acceleration could be nonlinear. Yet volatility must be respected. Silver has a history of sharp drawdowns even within bullish environments. 20 or 30% corrections are not uncommon. Conviction without appropriate position sizing can lead to forced exits during temporary weakness. Sustainable participation requires sizing positions in a way that accommodates volatility. For investors evaluating allocation, discipline is critical. Precious metals exposure should reflect overall portfolio objectives, risk tolerance, and time horizon. Silver's potential upside may be substantial under certain conditions, but uncertainty in timing and magnitude remains. Physical ownership provides direct exposure without counterparty risk, though it does not generate yield. Exchange-traded instruments offer liquidity and convenience, but rely on financial infrastructure. Mining equities provide leverage to price, but introduce operational, geopolitical, and management risks. Each vehicle serves different strategic purposes. Time horizon alters interpretation dramatically. For those focused on short-term movements measured in months, the $500 projection may be largely irrelevant. Short-term price action is influenced by liquidity flows, macro headlines, and sentiment shifts. For those operating on multi-year horizons, structural supply deficits and ratio dynamics become more meaningful. For investors thinking in decades, the possibility of a multi-decade repricing phase may not appear excessive. Another often overlooked variable is resilience. Markets rarely move in straight lines. Structural bull phases can include prolonged sideways periods and abrupt retracements. Emotional durability becomes a competitive advantage. Investors who position appropriately and maintain discipline through volatility are better equipped to benefit from structural trends. Ultimately, the $500 silver projection functions less as a definitive forecast and more as a stress test of assumptions. It forces examination of supply elasticity, industrial dependence, ratio distortions, and macro stability. Even if the ultimate price achieved differs from the projection, understanding the structural drivers enhances analytical clarity. Everything discussed here is grounded in publicly available production data, historical chart analysis, documented demand trends, and straightforward ratio mathematics. None of it constitutes a guarantee. It is not a directive to buy or sell any asset. It is a framework for evaluating structural conditions that may be unfolding beneath surface-level price fluctuations. Whether silver eventually approaches $500 or stabilizes at lower levels, the analytical exercise remains valuable. Markets reward disciplined evaluation more consistently than emotional reaction. The objective is not blind belief or reflexive skepticism. The objective is informed judgment. History repeatedly shows that transformative opportunities often appear unreasonable at inception and obvious in hindsight. The challenge is distinguishing between unreasonable and unprecedented before outcomes crystallize. The discipline lies in studying the evidence, sizing positions responsibly, and maintaining flexibility as new information emerges. If the structural forces described here continue aligning, technical confirmation, persistent deficits, industrial expansion, and ratio compression, the path toward substantially higher silver prices remains open. If those forces weaken, reassessment becomes necessary. Evaluation, not emotion, determines longevity in markets.